Section 3 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Part 1, Crisis on the Horizon, Chapter 1, Before Our Very Eyes. In examining the worst financial meltdown since the Great Depression, the Financial Crisis Inquiry Commission reviewed millions of pages of documents and questioned hundreds of individuals, financial executives, business leaders, policymakers, regulators, community leaders, people from all walks of life, to find out how and why it happened. In public hearings and interviews, many financial industry executives and top public officials testified that they had been blindsided by the crisis, describing it as a dramatic and mystifying turn of events. Even among those who worried that the housing bubble might burst, few, if any, foresaw the magnitude of the crisis that would ensue. Charles Prince, the former chairman and chief executive officer of Citigroup, Inc., called the collapse in housing prices wholly unanticipated. Warren Buffett, the chairman and chief executive officer of Berkshire Hathaway, Inc., which, until 2009, was the largest single shareholder of Moody's Corporation, told the commission that, quote, very, very few people could appreciate the bubble, unquote, which he called a mass delusion shared by 300 million Americans. Lloyd Blankfein, the chairman and chief executive officer of Goldman Sachs Group, Inc., likened the financial crisis to a hurricane. Regulators echoed a similar refrain. Ben Bernanke, the chairman of the Federal Reserve Board since 2006, told the commission a perfect storm had occurred that regulators could not have anticipated. But when asked about whether the Fed's lack of aggressiveness in regulating the mortgage market during the housing boom was a failure, Bernanke responded, "It was indeed. I think it was the most severe failure of the Fed in this particular episode." Alan Greenspan, the Fed chairman during the 2 decades leading up to the crash, told the commission that it was beyond the ability of regulators to ever foresee such a sharp decline. Quote, history tells us regulators cannot identify the timing of a crisis or anticipate exactly where it will be located or how large the losses and spillovers will be, unquote. In fact, there were warning signs. In the decade preceding the collapse, there were many signs that house prices were inflated, that lending practices had spun out of control, that too many homeowners were taking on mortgages and debt they could ill afford, and that risks to the financial system were growing unchecked. Alarm bells were clanging inside financial institutions, regulatory offices, consumer service organizations, state law enforcement agencies, and corporations throughout America, as well as in neighborhoods across the country. Many knowledgeable executives saw trouble and managed to avoid the train wreck, while countless Americans joined in the financial euphoria that seized the nation. Many others were shouting to government officials in Washington and within state legislatures, pointing to what would become a human disaster, not just an economic debacle. Everybody in the whole world knew that the mortgage bubble was there, said Richard Breeden, the former chairman of the Securities and Exchange Commission appointed by President George H.W. Bush. I mean, it wasn't hidden. You cannot look at any of this and say that the regulators did their job. This was not some hidden problem. It wasn't out on Mars or Pluto or somewhere. It was right here. You can't make trillions of dollars worth of mortgages and not have people notice. Paul McCulley, a managing director at PIMCO, one of the nation's largest money management firms, told the commission that he and his colleagues began to get worried about serious signs of bubbles in 2005. They therefore sent out credit analysts to 20 cities to do what he called old-fashioned shoe leather research, talking to real estate brokers, mortgage brokers, and local investors about the housing and mortgage markets. They witnessed what he called the outright degradation of underwriting standards, Macaulay asserted, and they shared what they had learned when they got back home to the company's Newport Beach, California headquarters. And when our group came back, they reported what they saw, and we adjusted our risk accordingly, Macaulay told the commission. The company severely limited its participation in risky mortgage securities. Veteran bankers, particularly those who remembered the savings and loan crisis, knew that age-old rules of prudent lending had been cast aside. Arnold Catani, the chairman of Bakersfield, California-based Mission Bank, told the commission that he grew uncomfortable with the pure lunacy he saw in the local home-building market. Fueled by voracious Wall Street investment banks, he thus opted out of certain kinds of investments by 2005. William Martin, the vice chairman and chief executive officer of Service First Bank of Nevada, told the FCIC that the desire for a high and quick return blinded people to fiscal realities. You may recall Tommy Lee Jones in Men in Black, where he holds a device in the air and with a bright flash wipes clean the memories of everyone who has witnessed an alien event, he said. Unlike so many other bubbles, tulip bulbs in Holland in the 1600s, South Sea stocks in the 1700s, internet stocks in the late 1990s, this one involved not just another commodity, but a building block of community and social life, and a cornerstone of the economy, the family home. Homes are the foundation upon which many of our social, personal, governmental, and economic structures rest. Children usually go to schools linked to their home addresses. Local governments decide how much money they can spend on roads, firehouses, and public safety based on how much property tax revenue they have. House prices are tied to consumer spending. Downturns in the housing industry can cause ripple effects almost everywhere. When the Federal Reserve cut interest rates early in the new century and mortgage rates fell, home refinancing surged, climbing from $460 billion in 2000 to $2.8 trillion in 2003, allowing people to withdraw equity built up over previous decades and to consume more despite stagnant wages. Home sales volume started to increase, and average home prices nationwide climbed, rising 67% in 8 years by one measure, and hitting a national high of $227,100 in early 2006. Home prices in many areas skyrocketed. Prices increased nearly 2.5 times in Sacramento, for example, in just 5 years, and shot up by about the same percentage in Bakersfield, Miami, and Key West. Prices about doubled in more than 110 metropolitan areas, including Phoenix, Atlantic City, Baltimore, Fort Lauderdale, Los Angeles, Poughkeepsie, San Diego, and West Palm Beach. Housing starts nationwide climbed 53%, from 1.4 million in 1995 to more than 2 million in 2005. Encouraged by government policies, home ownership reached a record 69.2% in the spring of 2004, although it wouldn't rise an inch further even as the mortgage machine kept churning for another 3 years. By refinancing their homes, Americans extracted $2 trillion in home equity between 2000 and 2007, including $334 billion in 2006 alone, more than 7 times the amount they took out in 1996. Real estate speculators and potential homeowners stood in line outside new subdivisions for a chance to buy houses before the ground had even been broken. By the first half of 2005, more than 1 out of every 10 home sales was to an investor, speculator, or someone buying a second home. Bigger was better, and even the structures themselves ballooned in size. The floor area of an average new home grew by 15% to 2,277 square feet in the decade from 1997 to 2007. Money washed through the economy like water rushing through a broken dam. Low interest rates and then foreign capital helped fuel the boom. Construction workers, landscape architects, real estate agents, loan brokers, and appraisers profited on Main Street, while investment bankers and traders on Wall Street moved even higher on the American earnings pyramid. And the share prices of the most aggressive financial service firms reached all-time highs. Homeowners pulled cash out of their homes to send their kids to college, pay medical bills, install designer kitchens with granite counters, take vacations, or launch new businesses. They also paid off credit cards, even as personal debt rose nationally. Survey evidence shows that about 5% of homeowners pulled out cash to buy a vehicle, and over 40% spent the cash on a catch-all category including tax payments, clothing, gifts, and living expenses. Renters used new forms of loans to buy homes and to move to suburban subdivisions, erecting swing sets in their backyards and enrolling their children in local schools. In an interview with the commission, Angelo Mozzillo, the longtime CEO of Countrywide Financial, a lender brought down by its risky mortgages, said that a gold rush mentality overtook the country during these years, and that he was swept up in it as well. Quote, housing prices were rising so rapidly, at a rate that I'd never seen in my 55 years in the business, that people, regular people, average people, got caught up in the mania of buying a house and flipping it, making money. It was happening. They buy a house, make $50,000, and talk at a cocktail party about it. Housing suddenly went from being part of the American dream to house my family, to settle down. It became a commodity. That was a change in the culture. It was sudden, unexpected, unquote. On the surface, it looked like prosperity. After all, the basic mechanisms making the real estate machine hum, the mortgage lending instruments, and the financing techniques that turned mortgages into investments called securities, which kept cash flowing from Wall Street into the U.S. housing market, were tools that had worked well for many years. But underneath, something was going wrong. Like a science fiction movie in which ordinary household objects turn hostile, familiar market mechanisms were being transformed. The time-tested 30-year fixed-rate mortgage with a 20% down payment went out of style. There was a burgeoning global demand for residential mortgage-backed securities that offered seemingly solid and secure returns. Investors around the world clamored to purchase securities built on American real estate, seemingly one of the safest bets in the world. Wall Street labored mightily to meet that demand. Bond salesmen earned multi-million-dollar bonuses packaging and selling new kinds of loans offered by new kinds of lenders into new kinds of investment products that were deemed safe but possessed complex and hidden risks. Federal officials praised the changes. These financial innovations, they said, had lowered borrowing costs for consumers and moved risks away from the biggest and most systemically important financial institutions. But the nation's financial system had become vulnerable and interconnected in ways that were not understood by either the captains of finance or the system's public stewards. In fact, some of the largest institutions had taken on what would prove to be debilitating risks. Trillions of dollars had been wagered on the belief that housing prices would always rise and that borrowers would seldom default on mortgages even as their debt grew. Shaky loans had been bundled into investment products in ways that seemed to give investors the best of both worlds, high yield, risk free, but instead, in many cases, would prove to be high risk and yield free. All this financial creativity was a lot like cheap sangria, said Michael Mayo, a managing director and financial services analyst at Callion Securities USA, Inc. A lot of cheap ingredients repackaged to sell at a premium, he told the commission. Might taste good for a while, but then you get headaches later and you have no idea what's really inside. The securitization machine began to guzzle these once rare mortgage products with their strange sounding names: Alt-A, Subprime, IO, or interest only, Low Doc, No Doc, or Ninja, no income, no job, no assets loans, 2-28s and 3-27s, liar loans, piggyback second mortgages, payment option or pick-a-pay adjustable rate mortgages, new variants on adjustable rate mortgages called exploding ARMs featured low monthly costs at first, but payments could suddenly double or triple if borrowers were unable to refinance. Loans with negative amortization would eat away the borrower's equity. Soon there were a multitude of different kinds of mortgages available on the market, confounding consumers who didn't examine the fine print, baffling conscientious borrowers who tried to puzzle out their implications, and opening the door for those who wanted in on the action. Many people chose poorly. Some people wanted to live beyond their means, and by mid-2005, nearly 1/4 of all borrowers nationwide were taking out interest-only loans that allowed them to defer the payment of principal. Some borrowers opted for non-traditional mortgages because that was the only way they could get a foothold in areas such as the sky-high California housing market. Some speculators saw the chance to snatch up investment properties and flip them for profit, and Florida and Georgia became a particular target for investors who used these loans to acquire real estate. Some were misled by salespeople who came to their homes and persuaded them to sign loan documents on their kitchen tables. Some borrowers naively trusted mortgage brokers who earned more money placing them in risky loans than in safe ones. With these loans, buyers were able to bid up the prices of houses even if they didn't have enough income to qualify for traditional loans. Some of these exotic loans had existed in the past, used by high-income, financially secure people as a cash management tool. Some had been targeted to borrowers with impaired credit, offering them the opportunity to build a stronger payment history before they refinanced. But the instruments began to deluge the larger market in 2004 and 2005. The change occurred almost overnight. Faith Schwartz, then an executive at the subprime lender Option One, and later the executive director of Hope Now, a lending industry foreclosure relief group, told the Federal Reserve's Consumer Advisory Council, "I would suggest most every lender in the country is in it, one way or another." At first, not a lot of people really understood the potential hazards of these new loans. They were new, they were different, and the consequences were uncertain. But it soon became apparent that what looked like newfound wealth was a mirage based on borrowed money. Overall mortgage indebtedness in the United States climbed from $5.3 trillion in 2001 to $10.5 trillion in 2007. The mortgage debt of American households rose almost as much in the 6 years from 2001 to 2007 as it had over the course of the country's more than 200-year history. The amount of mortgage debt per household rose from $91,500 in 2001 to $149,500 in 2007. With a simple flourish of a pen on paper, millions of Americans traded away decades of equity tucked away in their homes. Under the radar, the lending and the financial services industry had mutated. In the past, lenders had avoided making unsound loans because they would be stuck with them in their loan portfolios. But because of the growth of securitization, it wasn't even clear anymore who the lender was. The mortgages would be packaged, sliced, repackaged, insured, and sold as incomprehensibly complicated debt securities to an assortment of hungry investors. Now, even the worst loans could find a buyer. More loan sales meant higher profits for everyone in the chain. Business boomed for Christopher Cruz, a Maryland-based corporate educator who trained loan officers for companies that were expanding mortgage originations. He crisscrossed the nation, coaching about 10,000 loan originators a year in auditoriums and classrooms. His clients included many of the largest lenders, Countrywide, AmeriQuest, and Ditech among them. Most of their new hires were young, with no mortgage experience, fresh out of school, and with previous jobs flipping burgers, he told the FCIC. Given the right training, however, the best of them could easily earn millions. I was a sales and marketing trainer in terms of helping people to know how to sell these products to, in some cases, frankly unsophisticated and unsuspecting borrowers, he said. He taught them the new playbook. You had no incentive whatsoever to be concerned about the quality of the loan, whether it was suitable for the borrower or whether the loan performed. In fact, you were in a way encouraged not to worry about those macro issues. He added, I knew that the risk was being shunted off. I knew that we could be writing crap, But in the end, it was like a game of musical chairs. Volume might go down, but we were not going to be hurt. On Wall Street, where many of these loans were packaged into securities and sold to investors around the globe, a new term was coined: IBG, YBG. I'll be gone, you'll be gone. It referred to deals that brought in big fees up front while risking much larger losses in the future. And for a long time, IBG-YBG worked at every level. Most home loans entered the pipeline soon after borrowers signed the documents and picked up their keys. Loans were put into packages and sold off in bulk to securitization firms, including investment banks such as Merrill Lynch, Bear Stearns, and Lehman Brothers, and commercial banks and thrifts such as Citibank, Wells Fargo, and Washington Mutual. The firms would package the loans into residential mortgage-backed securities that would mostly be stamped with AAA ratings by the credit rating agencies and sold to investors. In many cases, the securities were repackaged again into collateralized debt obligations, or CDOs, often composed of the riskier portions of these securities, which would then be sold to other investors. Most of these securities would also receive the coveted AAA ratings that investors believed attested to their quality and safety. Some investors would buy an invention from the 1990s called a credit default swap, or CDS, to protect against the securities defaulting. For every buyer of a credit default swap, there was a seller. As these investors made opposing bets, the layers of entanglement in the securities market increased. The instruments grew more and more complex. Collateralized debt obligations were constructed out of collateralized debt obligations, creating CDOs squared. When firms ran out of real product, they started generating cheaper to produce synthetic collateralized debt obligations, composed not of real mortgage securities, but just of bets on other mortgage products. Each new permutation created an opportunity to extract more fees and trading profits, and each new layer brought in more investors wagering on the mortgage market, even well after the market had started to turn. So by the time the process was complete, a mortgage on a home in South Florida might become part of dozens of securities owned by hundreds of investors, or parts of bets being made by hundreds more. Treasury Secretary Timothy Geithner, the president of the New York Federal Reserve Bank during the crisis, described the resulting product as cooked spaghetti that became hard to untangle. Ralph Coffey spent several years creating collateralized debt obligations for Bear Stearns, and a couple more years on the repurchase or repo desk, which was responsible for borrowing money every night to finance Bear Stearns' broader securities portfolio. In September 2003, Coffey created a hedge fund within Bear Stearns with a minimum investment of $1 million. As was common, he used borrowed money, up to $9 borrowed for every $1 from investors, to buy collateralized debt obligations. Coffey's first fund was extremely successful. It earned 17% for investors in 2004 and 10% in 2005, after the annual management fee and the 20% slice of the profit for Coffey and his Bear Stearns team. and grew to almost $9 billion by the end of 2005. In the fall of 2006, he created another, more aggressive fund. This one would shoot for leverage of up to 12 to 1. By the end of 2006, the two hedge funds had $18 billion invested, half in securities issued by collateralized debt obligations centered on housing. As a CDO manager, Coffey also managed another $18 billion of mortgage-related collateralized debt obligations for other investors. Coffey's investors and others like them wanted high-yielding mortgage securities. That in turn required high-yielding mortgages. An advertising barrage bombarded potential borrowers, urging them to buy or refinance homes. Direct mail solicitations flooded people's mailboxes. Dancing figures depicting happy homeowners boogied on computer monitors. Telephones began ringing off the hook with calls from loan officers offering the latest loan products. 1% loan, but only for the first year. No money down, leaving no equity if home prices fell. No income documentation needed. Mortgages soon dubbed liar loans by the industry itself. Borrowers answered the call, many believing that with ever-rising prices, housing was the investment that couldn't lose. In Washington, 4 intermingled issues came into play that made it difficult to acknowledge the looming threats. First, efforts to boost homeownership had broad political support from Presidents Bill Clinton and George W. Bush and successive Congresses, even though, in reality, the homeownership rate had peaked in the spring of 2004. Second, the real estate boom was generating a lot of cash on Wall Street and creating a lot of jobs in the housing industry at a time when performance in other sectors of the economy was dreary. Third, many top officials and regulators were reluctant to challenge the profitable and powerful financial industry. And finally, policymakers believed that even if the housing market tanked, the broader financial system and economy would hold up. As the mortgage market began its transformation in the late 1990s, consumer advocates and frontline local government officials were among the first to spot the changes. Homeowners began streaming into their offices to seek help in dealing with mortgages they could not afford to pay. They began raising the issue with the Federal Reserve and other banking regulators. Bob Nasda, the general counsel and policy director of the Greenlining Institute, a California-based nonprofit housing group, told the commission that he began meeting with Greenspan at least once a year starting in 1999, each time highlighting to him the growth of predatory lending practices and discussing with him the social and economic problems they were creating. One of the first places to see the bad lending practices envelop an entire market was Cleveland, Ohio. From 1989 to 1999, home prices in Cleveland rose 66%, climbing from a median of $75,200 to $125,100, while home prices nationally rose about 49% in those same years. At the same time, the city's unemployment rate, ranging from 5.8% in 1990 to 4.2% in 1999, more or less tracked the broader U.S. pattern. James Rockakis, the longtime county treasurer of Cuyahoga County, where Cleveland is located, told the commission that the region's housing market was juiced by flipping on mega steroids, with rings of real estate agents, appraisers, and loan originators earning fees on each transaction and feeding the securitized loans to Wall Street. City officials began to hear reports that these activities were being propelled by new kinds of non-traditional loans that enabled investors to buy properties with little or no money down and gave homeowners the ability to refinance their houses regardless of whether they could afford to repay the loans. Foreclosures shot up in Cuyahoga County from 3,500 a year in 1995 to 7,000 a year in 2000. Rockakis and other public officials watched as families who had lived for years in modest residences lost their homes. After they were gone, many homes were ultimately abandoned, vandalized, and then stripped bare as scavengers ripped away their copper pipes and aluminum siding to sell for scrap. Securitization was one of the most brilliant financial innovations of the 20th century, Rockakis told the commission. It freed up a lot of capital. If it had been done responsibly, it would have been a wondrous thing, because nothing is more stable, there's nothing safer than the American mortgage market. It worked for years, but then people realized they could scam it. Officials in Cleveland and other Ohio cities reached out to the federal government for help. They asked the Federal Reserve, the one entity with the authority to regulate risky lending practices by all mortgage lenders, to use the power it had been granted in 1994 under the Homeownership and Equity Protection Act, or HEPA, to issue new mortgage lending rules. In March 2001, Fed Governor Edward Gramlich, an advocate for expanding access to credit, but only with safeguards in place, attended a conference on the topic in Cleveland. He spoke about the Fed's power under HEPA, declared some of the lending practices to be clearly illegal, and said they could be combated with legal enforcement measures. Looking back, Rockakis remarked to the commission, "I naively believed they'd go back and tell Mr. Greenspan, and presto, we'd have some new rules. I thought it would result in action being taken. It was kind of quaint." End of section 3.